If you're older than your early 40s, you've probably never experienced inflation like this right now. Now, if you're older than your early 40s, the news of inflation is sounding more and more like the early 80s, right? Just without the crazy neon workout gear, headbands, and leg warmers, I guess. What I'm really talking about is that U.S. consumer prices last month soared 8.5% from a year earlier, which is the fastest annual pace since 1981. So I want to share with you a few nuggets from the Labor Department's report. I think these are really telling signs of where we are as an economy, specifically when it comes to inflation. First, gasoline prices. They skyrocketed 48%, which accounted for half of the monthly increases. Cereal prices, which is a staple at the Hobart household, they jumped 9.2%. And meat prices, they spiked even more, 14.8%. And just in time for spring and summer travel, airline fares gained 10.7% in just the last month alone. But there are some hopeful signs. Used car prices, they spiked 35% over the past year. Well, they finally fell from February to March. And core CPI, what that does is it removes volatile food and energy prices from the equation. It ticked up just 0.3% for the month versus the expected 0.5%. Now, some analysts, they said that softer than projected core CPI reading could indicate inflation growth peaked in March. Now, if that's the actual case, it'll mean we finally, crested a mountain riddled with a bunch of false summits so far. Now, in the summer of 2021, the Fed considered inflation what's called transitory, and that means that they really thought it was related to COVID-related supply chain bottlenecks. But the shortages persisted, consumer demand remained high, and Russia then invaded Ukraine, which wiped out a chunk of food and energy supplies, and then China locked down Shanghai. All of this provides the U.S. a lot of components for their factories. So where are we now? Well, if inflation were to moderate, it's going to be due to a couple of reasons. First, there's going to be what we call organic causes, things such as supply chains smoothing out, and we're seeing that, and Americans pulling back on spending. After all, higher prices tend to slow people's spending. Second, policy interventions, and most notably the Fed hiking interest rates to raise borrowing costs for consumers and businesses should slow down the easiness of money. But here's the thing, even if those remedies do their job, it's likely going to take years for price growth to return to the Fed's 2% target rate. We're way over that right now. Now, this time, what are we doing? Well, at Hobart, we're being super diligent of the impact of interest rates on the stock market and the negative effects of the rising interest rates that they can have on bonds and bond funds. Remember, as interest rates rise, the value of a bond goes down. We're here with the answers. Just give us a call or drop us a line if you have any questions.